The webinar will begin in 3 minutes. The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome everyone, and thanks for joining us for today's webinar, RMD Management in 2021 and Beyond. The webinar will last approximately 15 to 20 minutes, and at the end you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limeberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks, Jennifer, and hello, everyone. Appreciate all of you being here this morning. With all that changed in calendar year 2020, I think it's easy to forget that some things are back to normal this year, including minimum distributions. And so we're going to spend the next 15 minutes or so reminding ourselves of what's up with regard to minimum distributions so that you can remind your clients But before we do that, let's decide on what we're going to talk about next month. As our regular participants no longer, as our regular participants know, we do this webinar and it's free. We do it on the first Wednesday of every month. And next month's is going to be on March 3rd. So let's decide on the topic. The three choices are the settlement of Prince's estate, HSAs in a nutshell, and the third choice is death to restricted property trusts. We ask that you choose your preference and when the poll opens, and let's open the poll now. Go ahead and take a couple minutes or a couple of seconds to vote. We'll take maybe 30 seconds for this. If you haven't voted yet, please go ahead and do so. All right, let's go ahead and close the poll, and next month we will discuss the settlement of Prince's estate. Thank you all for participating in that and for helping to make sure that our content continues to be relevant. So I mentioned that we're going to talk about required minimum distributions in today's topics, and as I mentioned in the introduction, RMDs were suspended for qualified accounts both while the owner was alive and for inherited accounts as part of the CARES Act in 2020. And the CARES Act provisions have not been extended into 2021, at least as of this moment. In addition to that, in late 2019, the IRS issued proposed regulations updating its tables for RMDs. And the tables were changed with regard to both distributions while the account owner is alive and for inherited accounts. The new tables were supposed to go into effect this year, but then the COVID pandemic hit and the IRS finalized regulations, made some significant changes, and the effective date for the new tables has been put off. But you need to at least know about that so that you can inform your clients as you're visiting them this year about RMDs that the tables for their RMDs for the following year, for many of them, are going to change. So we'll talk about that in just a little bit of detail in a second. So those of you on the call will remember that the CARES Act and the follow-up notice from the IRS eliminated the need for RMDs from IRAs and most employer-sponsored plans in 2020. But that the distribution requirements for inherited non-qualified annuities were not changed, right? So if your client inherited a non-qualified annuity for prior to 2020, they still needed to take an RMD if they elected to stretch based on life expectancy. There was some relief as part of the CARES Act that allowed for an extended rollover period. The extended rollover period has long since expired. It was the end of August for RMDs that were taken at the beginning of the year. RMDs that were mistakenly taken near the end of 2020 because of some automatic distribution feature, perhaps on an IRA or other qualified account, those may still be eligible for 60-day rollover. We're still within 60 days of the end of 2020, so you should be aware of that. And for those that might have taken minimum distributions or distributions that they didn't technically need to take, got to have the conversation with them about rollovers. And then there's one thing that I do want to mention as well, that while RMDs were waived in 2020 for most folks, qualified charitable distributions were still possible. And any QCDs that were sent to qualified charities in 2020 will still be valid. That is, they will not hit the client's income tax at all for qualified charitable distributions done in 2020, even though RMDs were waived. So what plans might we make with regard to 2020 minimum distributions? what are the things that that have changed for us? Well, you probably remember that the Secure Act changed the required beginning date. For those who turned 70 and a half in 2019 or earlier, the required beginning date is April 1st of the year in which, following the calendar year in which the participant turned 70 and a half. And that was true for those who turned 70 and a half in 2019, even though 2020 RMDs were waived. And in fact, those that turned 70 and a half in 2019 and delayed their 2019 RMD until April 1st of 2020 also had their RMD waived. For those who turn 70 and a half in 2020 or later, the required beginning date is April 1st of the year and following the year, the calendar year in which the participant attains age 72. So the key age has been raised from 70 and a half to 72. And the same rule applies to employer plans. Although the still working delay of minimum distribution for those who don't own the company is still available. So if you don't own the company and you're still working, you get to put off RMDs until you're not working, except if your qualified plan is an IRA-based plan like a SEP or a simple. SEPs or simples, you still got to start RMDs at the regular time, beginning by April 1st of the year after the year in which you turn 72. So lots of rules, lots of things to keep straight in our heads as we're talking to our clients. So while the account owner is alive, we're still using, for minimum distribution calculations for most people, the uniform lifetime table. For inherited accounts, we're generally using the single life expectancy table. While the account owner is alive, if the account owner has a much younger spouse, more than 10 years younger, we get to use the joint survivor life expectancy table to get slightly lower minimum distributions while the account owner is alive. These tables can be found in the IRS publication 590B, and these are the tables. The tables are still current in 590B that will be used to make minimum distribution calculations in 2021. But those tables are expected to be updated to the new tables in 2022. And the new tables are a little bit more generous with regard to life expectancy, meaning that the minimum distributions will be lower, all things being equal, for most of those who start RMDs in 2022 or later, and for some living account owners who are taking RMDs in 2022 or later. And if you've helped your clients calculate minimum distributions, you know that you take factors from the table and you divide them from the prior end of year prior account balance to come up with the minimum distribution amount. And that part of how the distributions are calculated hasn't really changed. So I mentioned that there are new tables that will be effective for 2022, and the RMDs will generally be lower while the account owner is alive and for newly inherited accounts, but we'll still use the old factors for non-spouse inherited stretch calculations. We are locked into the old table apparently, and we're still subtracting one for each year from the initial factor that we've used. There we go. We still have to know something about what the old table said, even though the new tables will be in effect for accounts where the owner is living and for newly inherited accounts. So much like other stuff in the Secure Act, we've got to keep a lot of information in our heads as we're working with our clients on how to sort this information out. So Secure Act did not change RMD requirements for qualified accounts inherited prior to 2020, but made some big changes for accounts that are inherited in 2020 or later. Used to be that non-spouse beneficiary could always stretch based on life expectancy on an inherited qualified account. But for those accounts where the account owner died in 2020 or later, we've got a new set of rules. We've got a whole new class of beneficiary called eligible designated beneficiaries. The class of eligible designated beneficiaries, the special beneficiaries are minor kids of the account owner, disabled or chronically ill people, or named beneficiaries who are no more than 10 years younger than the deceased account owner. If you fall in that category, you're special, you're an EDB, an eligible designated beneficiary. Everybody else is a regular beneficiary. A surviving spouse is also in a special category, eligible designated beneficiary, and we'll talk about what that means here right now. So the rules with regard to stretch, where a spouse is the named beneficiary, are substantially similar to what they were prior to the Secure Act rules. And that is that the surviving spouse's probable most popular choice is going to be to put the inherited account in the spouse's own name, either by transfer or rollover or by retitling. You know, all of those options tend to be available where surviving spouse is the beneficiary. Surviving spouse can make the account her own, and the normal rules with regard to distributions will apply to that account, just as if the surviving spouse owned the account for the beginning. If the surviving spouse also has the ability to treat the account as inherited and to take minimum distributions based on the surviving spouse's life expectancy. And that, if that choice is made, the RMDs tend to be larger, but the penalty tax won't apply to distributions taken from those kinds of accounts if the surviving spouse is younger than age 59 and a half. And oh, by the way, stretch doesn't have to be turned on until the year in which the deceased spouse would have turned 72. And the same options are available whether the surviving spouse inherited either before or after the deceased spouse had started minimum distribution. So basically it's roll into the spouse's own account, that's choice number one, or stretch based on the surviving spouse's life expectancy beginning in the year the deceased spouse would have turned 72. That's the second choice. Similar to the choices available pre-secure, still available to surviving spouse post-secure. So let's talk about non-spouse beneficiaries. Used to be that non-spouse beneficiary could stretch based on life expectancy. Now the rule is non-spouse beneficiary who is not special, non-spouse beneficiary, must liquidate the inherited account, the inherited qualified account, by the end of the 10th year after the owner's death. No RMDs are required along the way, but the account must be liquidated by the end of the 10th year after the original account owner's death, whether the original account owner was taking minimum distributions or not at the time of death. It gets much more dicey where there's a trust or estate as beneficiary, and the rules are really complicated. But basically, if it's a look-through trust under the old rules, probably we've got the same kind of 10-year liquidation rule that we had prior to the Secure Act. So those rules have not quite changed, but it gets a little bit more in depth if one of the beneficiaries of the trust is an eligible designated beneficiary. For example, if one of the beneficiaries of a trust, that's the beneficiary of an IRA, if one of the beneficiaries of the trust is a minor child, it's going to be a little bit hard to sort out exactly what the minimum distribution rules are, and we expect there to be some more clarification from the IRS, perhaps as soon as this year, as RMDs become post-Secure Act RMDs become more relevant. So if we've got an eligible named beneficiary as direct beneficiary, if it's a minor child, The minor child gets to stretch based on life expectancy until the age of majority. Once the minor child reaches the age of majority, then it's 10-year liquidation. Likewise, if we've got a disabled or chronically ill eligible beneficiary, as long as the impairment exists, the beneficiary gets to stretch based on life expectancy. If the impairment is over, then from that point forward, it's 10-year liquidation. If the beneficiary is no more than 10 years younger than the original account owner, we've still got stretch, which is based on the old rules, the old pre-Secure Act rules. So as you're going and talking to people who are inheriting qualified accounts, it's important for you to know who the beneficiaries are, what their status is, and which rule might apply, whether stretch might or might not be available. As an aside, you're also going to want to talk to your carriers that have accepted the transfer of inherited qualified accounts before into inherited IRAs, because what we're hearing anecdotally is some of them are reluctant to take those the transfer of those funds, because they realize they've only got a short period of time to try to make a profit on the money before the account must be liquidated. So check with them to see how they are dealing with the acceptance of a transfer of an inherited account. One of the interesting things is that while the stretch rules became in some ways simpler, but in some ways more complicated for inherited qualified accounts, IRAs, and employer-sponsored plans, the rules stayed the same for non-qualified annuities, at least so far. As we did in the past for a non-spouse beneficiary of a non-qualified annuity, we have the choice of either A, 5-year liquidation, or B, stretch based on the beneficiary's life expectancy. It's the same. The Secure Act didn't change any of that, nor did the Secure Act change anything about a spouse beneficiary's ability to treat the inherited non-qualified annuity as her own. So I suppose that's good news in a way, in that the rules didn't change. But the bad news is that we've got to keep a lot of different rules straight in our own heads as we're talking with our clients. So what's the message to take away from this? You know, I think those of us who are in the financial planning business need to help our clients think about how to manage the distributions from their regular retirement accounts and from an inherited accounts. The Secure Act and the new life expectancy tables have changed a lot about the nature of the advice that we're going to give about distributions. Some old plans may not make sense anymore about who we named as beneficiaries. And so we've got an opportunity to go visit with our clients who are at or near retirement age, who have non-qualified accounts or qualified accounts, or who are beneficiaries of such accounts. And all of that those are important conversations for us to have. We can advise those people pretty well. And with the new tables that are in place, it's going to change the way Section 72T and 72Q distributions are made going forward for new 72T or 72Q plans. And so we need to keep that in mind as we're advising our clients who are thinking about taking substantially equal distributions based on their life expectancy. We are advanced underwriting consultants. We answer tax and technical questions for a living for our clients. We have a YouTube channel. We'd love you to subscribe to that. And I would like to thank you again for joining us today. And at this point, let me turn the program back over to Jennifer. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us on March 3rd for the settlement of Prince's estate. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar to that email address. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.